We told you on the last show that you've got to look out for some of the points that are going to lose your savings. I told you about the coronavirus. That was one thing that came true. So you want to stay tuned for this show because we're going to give you a real insight for you baby boomers. Good morning, Ron.
Morning, Kath.
Good morning, everyone. Well, here we are. We're starting this show out with some wonderful things about financial advisors. Ron, tell us about what we're going to be looking at today.
Well, in the last couple of shows, we're warning baby boomers that they're taking too much risk. And I might be wrong about some, but the average boomer is about 60% in equities, stocks and real estate and convertibles and so on. And they really should be no more than 30% in equities. And the feedback we've been getting lately, I tell you why in the first two shows, but the feedback we've been getting is, so is my investment advisor wrong? He's telling me 60%. And the answer is yes, he is. But the reason is really, it's something that happened 15 years ago. And the financial community had an epiphany. And this revelation has reached its way into 401k plans big time. It's called target date funds. So the insights for target date funds have not yet made it to individual advisors and their clients. And that's a shame, because there's a lot of money that's not in 401k plans. It's in IRAs and personal savings. And what we're going to do today, Kath, is go through the reason that advisors are giving the advice that they're giving currently, roughly 60% in equities. And this is not a show about market timing, the sky is gray and coronavirus and all that. It's entirely about risk control, risk management, not calling the market turns. So it's going to get a little technical. And if you're watching and I start making your hair hurt,
Yeah. Well, yeah. If you don't understand it, either comment and let us know so we can clarify it, or go
Sure.
ahead, Ron. Yeah. Oh, Joanna's here.
Yeah.
Hi, Joanna.
So, hi, Joanna. So we're going to go through the 70-year history of financial consulting and financial theory. So it's going to be, in essence, like a 2-year graduate course. They're going to try to do in about 30 to 45 minutes. But again, if you're live with us, please hang in to the last 15 minutes. It'll be worth your time, because I'm going to show you the epiphany and how you need to benefit from it. If you're watching this on a replay, just fast forward if you're not liking the technology. But I think it's going to be really, really interesting. So please hang in there with us.
Okay, so let's begin.
Let's go.
Okay.
So that's our title slide. Let's skip the next slide, Kath, and just go to
Okay.
The next one. After that.
Okay.
So history of financial theory has had breakthroughs roughly every 10 to 15 years. And there have been 6 of those breakthroughs, and you can see them on the screen here. I'm going to go through each one of them in chronological order. And we'll start with the one that happened in 1952 on the next slide, Kath. And this is what's called modern portfolio theory. And notice the word modern. So Dr. Harry Markowitz introduced this theory 70 years ago. It took a good 30 years for this theory to actually be used and accepted. So these things happen gradually. And I'm telling you that because this newest epiphany 15 years ago, it's going to take maybe another 5 to 10 years before it's really accepted. So what Dr. Markowitz did was he said, we can plot the risk in investments, and we can plot the return. And on this graph, I'm showing several stocks like IBM and Xerox and Apple plotted as dots. And we can estimate how risky they are. And risk, by the way, is measured as the ups and downs, the volatility in the stock. And then return is sort of the expectation. And there's a lot of work done to develop return expectations on stocks. And you can plot that for the stocks. And by the way, you wouldn't take the risk in a stock unless it had higher expected return. You can do the same thing with bonds, and that's in the lower left. And then what the big breakthrough was 70 years ago now was Dr. Markowitz showed that if you just buy one or two stocks or one or two bonds, which was the common practice in the 50s, very concentrated portfolios, you would get the risk and return that's shown for the individual securities. But if you mix stocks with bonds, you get better return for the risk. And that is the red curve there. And the idea behind the red curve is you can't get any better than that return and risk. You can't move above that and over to the left. So that's called the efficient frontier, and evolved into this whole thing about efficient markets. And the real classy picture is on the next one, Kath.
I'm the slide person.
Yeah. By the way, Kathy's my sister, so we can almost do this telepathically, but I think that's a stretch.
And I'm the baby boomer, by the way, everyone. I'm the baby boomer that does not get any of this stuff. So everything that Ron is teaching, I'm actually learning from this. And I'm amazed with it. I'm very proud. So go ahead.
Thanks, Kath. So the real thing in modern portfolio theory is that there is a free lunch in investing, and it's called diversification. And in the graph on the right here, I just showed you the efficient frontier for just U.S. stocks and bonds. But if you will add other things to your portfolio, like foreign stocks, real estate, commodities, more diversifying assets, that improves the efficient frontier, and it gives you a higher return for the risk. It moves up and to the left. And that's the big breakthrough. So the next breakthrough happened roughly 10 years later on the next slide.
Oops.
And in 1964, 55 years ago now, Dr. William F. Sharp won a Nobel Prize. Actually, Harry Markowitz won the Nobel Prize in 1990 as well. It took a while for the Nobel Committee to recognize him. But Dr. Sharp said you can do better than the efficient frontier. And what he developed is the mathematics that basically said what everybody should really want is the most diversified portfolio they can get, essentially the world market portfolio. And that's the star in this graph. And that's about where it would fit on the efficient frontier. By the way, its composition is about 60% in equities. And it is part of the foundation for why the standard answer for many advisors is 60% in equities. But what Dr. Sharp showed was that if you want to take less risk than the world market portfolio, if you just stuck on the frontier, you would move down that nose of the frontier, if you would, and go more into bonds. But you can do better than that. And the way you can do better is to mix the world market portfolio with cash. And what that really says is that the way to control risk is to use cash. Cash is a good risk control. Now, even though this won a Nobel Prize, the capital market line, or capital asset pricing theory, as it's called, is not used much by consultants. And the thing that happens if consultants move to control risk with cash, the clients have said, I'm not going to pay you to run cash. I'll run my own cash. You run my portfolio. So it has not been used very much, but it's a very good theory, and it's real. So next slide, Kath, I'm going to show people what consultants did 55 years ago, and they're still doing it today.
So nothing's changed?
Not yet. So
okay.
the big thing is 15 years ago, things changed, but not for what I'm showing you right now. So this has survived 55 years in consulting. So what advisors do, and actually money managers do as well, is they build models, and they go along the frontier on the left-hand side of this chart. They're numbered 1 through 5. So they have some high-risk models, some low-risk models, and things in between. And you may think, it depends on your consultant or your money manager. There's one money manager in particular who's made a fortune saying, we don't cookie cut our portfolios, they're customized to you. And you guys probably know who he is. That's simply just not true. But it sells. So what you might see is a graph like the thing on the right. And this would be a consultant might show you this, or a money manager, but it's essentially the same story. But on the right, they're showing you sort of the mix between equities and bonds, and they call it tactical, but tactical would be moving to cash, essentially. Now, the makeup of these models is generally mutual funds and/or what's called exchange-traded funds. And exchange-traded funds are really like mutual funds, but they trade like stocks. So you can buy and sell an ETF just the way you can buy and sell Xerox or IBM or any other stock. So they're really nice for doing trading, and they actually have some tax efficiency built into them as well. So they've become really popular. Mutual funds are still the lion's share of the managed market. So on the next slide, I'm going to show you what consultants were doing 55 years ago, and many are still doing this, but there's been another breakthrough I'm going to show you. But they would work with their client to fill out a risk questionnaire, and the SEC actually requires advisors to know their client, and this is one way to do that. So you would fill out the risk questionnaire, and they would take your answer over to the right-hand side there and say, so you're risk level 2. You want to be pretty risky? We're going to put you in model number 2. Also, what's happened more recently is there are specialized consultants that are called robo-advisors. And these are advisors that work exclusively on the internet, so very little human contact. But they have really made a big part of what they provide to help you figure out how much risk you want to take. And that's not an easy question. It's a very important question. But that's how the consultant industry works. Then in terms of, everybody uses this, brokers, fiduciaries, but the next slide is on the Bible for fiduciaries. So in 1974, 46 years ago, an act was passed that governed fiduciaries. Now, there's a difference, by the way, between a fiduciary and a salesman. A salesman would be trying to sell you stocks or something else, and that's sort of the big difference between a broker and a fiduciary. So some brokers are fiduciaries, and that's certainly possible too. But one of the things that ERISA laid out, and it's the Employee Retirement Income Security Act. It's called ERISA. But it laid out the duty to diversify to avoid large losses. And that sets the stage for today what's called index investing. And there, in order to diversify, you would own the entire market. You wouldn't buy individual stocks. You buy the entire stock market using an index like the S&P 500. And not too long after that, on the next slide.
Okay. Hi, Lou. Hi, Dale.
Hi, Dale.
Hi, Lou.
Hi, Lou. So this is the third innovation in financial theory and consulting practices. In 1986, Dr. Robert Haugen published a book called The New Finance. And that is an amazing book. It's required reading for the Chartered Financial Analysts, the CFA Institute. But Dr. Haugen took the myriad of articles that prove that markets were efficient, basically that you can't beat the market, and took those very same studies and showed that if you really look carefully, that the data is saying just the opposite, that you can win. And interestingly, and this is really mathematically no surprise, if you want to win, you can't diversify. You have to make bets. So that was really a breakthrough, and it's 45 years ago. It took 20 years for these insights to reach the market. One of the things Dr. Haugen discovered, too, and that has been really a big deal in financial consulting lately, is that low-risk stocks actually have performed much better than theory would predict. So this value tilt, so lowest stocks are generally value stocks. So this tilt to value has become a popular thing to do. Although I will say, interestingly enough, in this run up over the last 10 years, growth stocks have outperformed value stocks. So this bargain thing hasn't worked so well. But one of the fun things Dr. Haugen did, and he got front page of Money Magazine, is he financially engineered what he called a super stock. And this is by judicious blending of various stocks, you could create basically a conglomerate that if it traded on the market, it would sell right away because it would have really good earnings. It would be low expense. Everything would be marvelous about it. And you can create it with financial engineering. So he was really a guy who said there are tools that you can use to make money, and all this stuff about diversification, everything that's all fine. But look at my tools because they're really good. Dr. Haugen, by the way, had great success. He passed away several years ago. But counter to that, the same year on the next slide, Kath, 1986, there was this very widely quoted study called the Determinants of Portfolio Performance. And sometimes it's called the Brinson-Biebauer-Hood study. And it was done by three practitioners, not academics, but practitioners, reviewing the performance of pension funds. So what explained why institutional money performed the way it did? They took thousands of funds and trillions of dollars, and the conclusion really shook up almost everybody. And it was this: the number one driver of why performance has been what it was through 1986 was how much you put in stocks, how much you put in bonds, how much you put in real estate. And that's called asset allocation. And then the other thing that they sort of a subtext there is stock selection, trying to pick stocks, or market timing, trying to call the turns, actually subtracted value. Now, how does that square with Dr. Haugen's research? Well, the fact is, at that time, Haugen was just starting to spread the word, and it took 20 years more to spread it. So this study is widely quoted, and I think to a large extent it's true. But there are certainly people who are maybe not using Dr. Haugen's work per se, but still in the camp where, yeah, I can beat the market. I'm really smart, and I know how to do that. And you may have an advisor who can do that. I'm not sure. I wouldn't know how. The next breakthrough happened several years later. It's on the next slide, Kath. And now in 1991, 30 years ago, Dr. Frank Sortino introduced postmodern portfolio theory, which, now remember, when Dr. Sortino introduced this modern portfolio theory, MPT was 40 years old. It was still being called modern. So Dr. Sortino called this postmodern portfolio theory. And he said, there's this whole thing about managing to risk and getting your risk right and all that. That's all good. But your clients probably have something they want to do with their money. Like maybe they want to retire with dignity, or maybe they want to buy a car 5 years from now. Or maybe
donate.
They might want to donate. They might want to leave because of fortune. Whatever it is they want to do, that's something that they can get their heads around. If you tell them their volatility or their beta or something else is X or Y, they don't understand that. Mm-hmm. So get real, guys, and just develop an objective for your client, and then don't just stop there. Track your progress towards achieving it and make changes as you go along. And he called that financial navigation. So what this chart is showing is you got the target, and then the line is you start out moving toward your target, but you're going to have some successes and some failures. And rather than just let things ride the way they are, you adjust to that. So if you're not making your target, you can try to increase your risk. You can try to save more. You can do a lot of things that will try to get you back on the path to success. And then the other thing that really revolutionized things is Dr. Sortino said, risk is not volatility, which had been the definition for it until this time. And he said it's totally different. It's the chance that you're not going to achieve your objective. So he developed a ratio called the Sortino ratio, and he's probably best known for that. But the fact is, he actually wrote some books, and I'm going to talk about that. But on the next slide, I'll show you how things work now under this other regime. So instead of trying to find the model based on what risk you want to take, we're going to try to find a model based on what you want to achieve. And this is called management to objectives. So the first step is to determine what rate of return you need to achieve your objective. And you can find calculators on the internet easily. Some people use things they found on the internet. Most advisors and money managers sort of build their own. But the general notion here is you tell the calculator, know what you have now, how much you're going to put into your savings each year, and then most importantly, what you want to have when your objective time is at hand. And with that information, you can solve for what rate of return gets you to where you want to be. So on the next slide, you take that required rate of return. Dr. Sortino called it an MAR, minimal acceptable return. And now, instead of going on the horizontal axis, the risk axis, you go on the vertical axis, and you say, here's my required rate of return, and here's the model that is expected to earn that rate of return. So in this case, it would be Model 3. Dr. Sortino wrote 2 books, and what I'm showing you here is sort of the common way investment consultants would manage 2 objectives. Dr. Sortino had a much more evolved and complicated way to do it. But the good news is he left a Dr. Sortino is a great guy, by the way. He's a friend. But he left a legacy when he retired, and that's free software. So people who are watching this and really have the acumen and the ability to operate and understand software, you can get Dr. Sortino's very good software by Googling Sortino's legacy. So he's left us all a gift. So now we've gone through 55 years, and let's summarize where the consulting industry was for the first 55 years. On the next slide, Kath. So we started out with risk-based consulting, and there we'd identify the client's preferred risk. And by the way, one of the things we're going to talk about is preferred risk is not the same as risk capacity. And that's a really nuanced thing, but a very important thing that just got discovered 15 years ago. So I'm just going to give you a little lead into what we're going to talk about at the end of the show. But so the preferred risk might be here as shown, risk level 2. But baby boomers really can't afford much risk for reasons I'm going to say. So they have there's no reason they should go in this chart any further than 4 at the most. Okay, moving on to the newer revelation, objective-based. It sort of works within the same framework of having efficient frontier and models, but now you go and use the required return to identify the model rather than the risk preference. So on the next slide, sort of a realization that I think most listeners to this who are using financial advisors know this, but financial consulting is a credence good. It's sort of like your car mechanic or your electrician or your plumber or your doctor. You sort of really need to trust. But the good news is I'm going to show you how to verify. So
good.
and there are easy ways to do it that I'm going to show you how to do. But just be aware that consulting is a tough competitive practice, because pretty much the ways that I showed you, either the risk-based or the objective-based approaches, using models is the way to go. I forgot to say, and I'll say it now, many consultants use what's called TAMPs, T-A-M-Ps, for turnkey asset management platforms, which basically means they have an outside firm develop and maintain the models that they use. So even more sort of commoditization of what goes on in consulting, because many of them are all using the same TAMPs. So it's very much a trusted advisor kind of marketplace. Now, there should be a drum roll now for the next slide, Kath. I don't know if you need a drum roll.
Oh, wait.
It's easy.
Well, that wasn't a drum roll, but it's close.
Yeah. Okay, good.
So this is the big breakthrough. And it may not look like a big breakthrough, but it is. So in 2006, the Pension Protection Act of 2006 sort of declared 3 ways that employers could invest the assets of 401k participants who could not make a decision. It's called a default. And the most popular by far was the option called a target date fund. And what I'm showing you here is my patented design. By the way, I should have said this before. I've been involved in this scenario. I've been involved with Dr. Haugen, Dr. Sortino, and now I've been very much involved with target date funds since 2007. I'm showing you my patented design. And what target date funds do is they start out, the horizontal scale here is how many years you have remaining to retirement. So it's young people on the far left. And then the vertical scale is asset allocation. So you start out for young people, roughly 90% in equities, very, very aggressive. And equities, again, are U.S. stocks, foreign stocks, real estate, commodities, anything but bonds. And then as you get closer to retirement, and I've started to line here at roughly 16 years to retirement, you've reduced your risk, but not that much. You're still roughly 75% in equities and 25% in bonds. But from that point on, my design anyway would move fairly quickly to get you out of harm's way and to use Dr. Sharp's capital asset pricing model and to control risk by using cash. And cash here is treasury bills and treasury inflation protected securities. They're called TIPS. And those protect you against inflation as well as against volatility. And my design brings you to very safe, only 5% in risky assets. I would say that going up as much as 30% may be okay, but you're running into danger at that point. My competitors are sort of like me up until 16 years to when you retire. And they end at the target date at about 60% in equities. And they lost in 2008 30% of the assets of people at or near retirement. The typical target date fund for people near retirement lost 30% in 2008. There's every indication now, largely because markets have become very, very expensive in the last 11 years, that the next correction easily could be worse than 2008. So that's part of the warning that we're giving you all. So what's really shown here is not 5 models, it's really hundreds of models, and also a huge success in the institutional marketplace in 401k plans. There's now more than $2 trillion. I just read today, it's now up to $2.5 trillion in 401k plans. So a really big deal that really has not yet reached the individual investment community. But I will tell you this, one of the shortcomings of target date funds in 401k plans is that they are one size fits all. So if you're on your plan, you might have a Vanguard target date fund or a Fidelity Vanguard fund, and you're in there with everybody else who is in their plans, not just in your company, but everybody who uses their target date fund. And good chance you're not like everybody else. And in particular, I'm here to tell you, you're going to take too much risk when you're near retirement. I'm even going a step further. If you're in a 401k plan, and you should check to see what the ending equity allocation is, but it's probably going to be north of 50% anyway. If you're near retirement, you're a boomer who's watching this show, you should get out of your target date fund in your 401k plan. Just get out.
Whoa.
Yeah. And move your money to some safe investments on your 401k plan. You will find some safe investments. So please worry. So the reason for everybody is on the next slide, Kath, to want to manage their risk capacity is called this risk zone. And the reality is that when we're working and getting paychecks, we can lose money, and that's the risk of loss. But as we start to leave the workforce and our paychecks are going to stop, and our account balances, by the way, the line there is the savings we have, the savings are going to peak. So we will probably saved as much as we're going to save. That is the time when the risk of loss becomes the risk of ruin. Because if now this is all we've got and we need to live on this for the rest of our life, and we lose a substantial portion of it, the only thing we can do is to change our lifestyle.
Right. We're sunk.
We are, and we can try to go back into the workforce, but that's not easy. I mean, Walmart probably has as
I
many
can attest to that. Yeah,
It's
Walmart, right? Yeah,
nothing against Walmart, but
yeah.
and this is the thing I'm going to discuss again, which is another breakthrough. But interestingly enough, once you've been in retirement for long enough, it sort of reverts away from this risk of ruin, and you're back in risk of loss. And I'm going to talk about another innovation there in about 2 minutes. But the benefits of target date funds are on the next slide, Kath. And this is why, rather than buying an off-the-shelf target date fund, which you really could, there's plenty of them out there, you'll find them easily. There's only 3 or 4 that will actually protect you as you're near retirement. You are far better off creating portfolios on your own that use the disciplines of target date fund and do what target date funds were designed to do, to have rigorous risk control. Don't take more risk than you can afford. And believe me, you can afford to take risk if you're nearing retirement or have been in retirement for a few years. And then the second benefit is diversification. So on the next slide, I'll show you risk control. And the story here is, and this is a thing that has not yet left the institutional investment community. So the retail community is not yet benefited from this, that it should. So the idea of risk capacity says the advisor should work with you to figure out how much money you can afford to lose, and recognize that unlike when you were young, losing money now means you've lost it forever, even if the capital markets come back. So there ought to be a line drawn here that says you cannot go beyond this purple line. And even if they work with you to say they want to work with you to achieve your objectives, and the objective is beyond that line, like Model 3 there. By the way, Model 3, I'm going to tip it now, is roughly the 60-40, 60% in equity portfolio. That is the common pat answer for most advisors. What they should work with you on, and this is hard, but they should say, you need to lower your objective, because the risk you need to take to achieve your objective is more risk than you can afford to take. And that is a hard message to deliver. And it may be the consultant feels he might jeopardize the account, but I think the better consultants will say that. And it's very much entrenched in the whole notion of off-the-shelf target date funds. But this would be a customized fund for you. It would be your personal portfolio. And then the notion of diversification is caught on largely, it's on the next slide, Kath. Is really caught on in large part due to the success of target date funds, because the bigger part of target date fund assets are in passive index investing rather than active. But also cost has become a criterion. And then last but not least, there's been studies that show the success of investment managers to beat their indexes, and it's abysmal. So there are some who can. They're really hard to find. But I think what's really happened now is the industry and investors and even consultants have largely given up on trying to add value through active management and have gravitated more to passive. And you can see here the green areas. This is a Morningstar report on the new monies going into stocks through June of 2018. And roughly 70% of the new monies went into passive index investing. So more risk control, more diversification. Those are the benefits for target date funds. Then the latest innovation 7 years ago is just on the next slide. We could have another drum roll here.
Yeah.
Great. So this is icing on the cake. So 7 years ago,
So
okay. Um, Dr. Wade Pfau and Michael Kitces, two renowned authorities, certainly on pension investing, wrote a very thoughtful article about how you should invest your assets in retirement. And what they showed is the optimal investment is to start very safe, like no more than 30% in equities, what I've been saying. And what that does is it protects you against this risk zone. But then once you're in retirement for 5 or 10 years, it's smart to try to extend the life of your savings by increasing your risk. So that completed a lifetime model. Target date funds only went through to when you retire and didn't have much smart to say about what you do after you've retired. So what I'm showing you here is several things. Let me start out with a really easy one. If you see the black line in the middle of the picture, the average individual retirement account is invested 60% in equities, regardless of age. So age is on the horizontal scale here. By the way, 70 is the date that I'm using here for retirement. And that's mind-blowing. This is based on a study by the Employee Benefit Research Institute. And what they reported is people are 20 years old and have an IRA, they're 60% in equities. People are 40 years old and have an IRA, they're 60% in equities. Folks who are 90 years old and have an IRA, they're 60% in equities.
What?
And that's
crazy.
Well, it's a reflection, I think, of this 60-40 kind of one-size-fits-all asset allocation idea that's been entrenched in the industry for 70 years.
Yeah.
And it's wrong. And it's wrong, I think, if you believe target date funds, in that it's way too safe for young people and way too aggressive for people who are near or in retirement, unless you're a risk taker, which I don't think many people are or should be. But there are, I'm told, people who like to take risk. So I'm showing three curves here. The one that I call defensive is my patented design. But you could move up and become a little more aggressive, and I show a moderate kind of lifetime asset allocation plan, or glide path, as it's called. And then the really aggressive one is what the current average target date fund is doing.
Ooh, that's scary. So they're really at risk a lot.
It's the average target date fund, mutual fund, is very risky. And again, a reason why, if you're in a 401k plan and have even been defaulted into a target date fund, if you've defaulted, you already said you don't know what to do. But I'll tell you, please think about getting out, because you're taking too much risk. So this little picture on the right basically says, now what we can do today that we couldn't do 15 years ago is take control of our life path, develop our objective, have our target, what we want to do. But we can move between those three defensive, moderate, or aggressive curves and still be on a glide path that makes some sense about getting to where you want to be.
Yay. Now that makes sense. That makes sense.
Yeah, it does. And let me just finally, now on the next slide, Kath. Now if you sort of fast forwarded, and
this is the last 15 minutes.
this is the last 15 minutes.
Yeah.
So we've been warning baby boomers that they're in danger of life-altering losses. And the warning is essentially, you need to get in touch with your risk capacity. You cannot afford to take the risk that you're probably taking. Now, I may be wrong about some of you, and that's fine. I'm happy for you. But in this little slide on the right, you're probably in sort of the middle of the models, model 3, and that's roughly 60% of stocks. And that's equivalent to taking the advice that you should buy the most expensive car you can buy. By the way, the most expensive car is $48 million.
Oh, ooh, so, it's on my wish list.
So even if you have that wallet, it's probably not a smart thing to do. But you really shouldn't be taking that kind of risk. There are 78 million baby boomers who are in the risk zone right now. And if you don't know what your current allocation is, you really should find out, because it's basic. But it shouldn't be any more than 30%. So If this is the first show you're watching, please see our two previous shows. In particular, the previous one we did on the 10 reasons baby boomers need to move to safety now. If you have the slide, you can click there. And also, we have a free ebook called The Bad Gamble. And the very last slide is some advice on where you can go for help. And even if you already have an advisor, I'm not saying all advisors are bad or good. There's certainly some better and worse than the others. But if you want a second opinion, I have a website up for you. It's called Age Sage Robo. And if you Google that, you'll find it'll come up to the top of the Google search. And there you'll be able to, for a small fee, $50, be able to see my recommended asset allocation for your circumstance. There's also two free ebooks there. One on the bad gamble that I mentioned, and then the other on the 4 pillars of smart investing. The other place you can get help is where if you don't want to do it yourself and you really do want to use an advisor, there's a website I'm involved in as well. It's called Glide Path Wealth Management. And if you Google that, you also get free ebooks there. One is on selecting an advisor, and the other is on retiring a millionaire, which would be very, very cool. So there is help, and please check us out. I think we're here to help. And also, please continue to watch our shows. I'm not sure how you might have gotten this replay or if you are watching live, you do know. But if you go to either Facebook or YouTube and look for the Baby Boomer Investing Show, you'll find it. Or you could look for Age Sage Robo. You'll find us in either place. And we appreciate your comments and hope you'll keep watching. Thank you.
Well, that was great, Ron. That was great.
Thanks.
We got a question here from Dale. He says, "Hi, Ron. I'm investing through Chase Private Client. This last drop in the market because of the coronavirus, I lost 3%, but it has already started to rebound. I'm not doing high risk. What are your thoughts for the rest of the year?"
Yeah, I I love that question. So if you're not taking much risk now, I just stay the course. If you were taking, I think this would be a good catalyst. So fear and greed move everybody, not just you or me. And so this whole coronavirus thing, I think what we said in the last show was we don't know what we don't know.
Right.
Now, today, the market is down. And
yesterday it went back up again. So it's
right.
up, down, yeah.
Well, it recovered a little this morning, but the Fed is taking extreme actions. So they lowered the prime rate 0.5% today, which they haven't done since 2008. And even though they're not supposed to be influenced by the president, he is leaning on them, and he's said it in his presentations all the time that the Fed should lower rates. And the obvious thing is the way the elections go is going to depend on what the economy is like come November, and that's going to go on. So I'm not answering your questions because I really don't know what's going to happen. But I think this getting your arms around risk capacity, and if you're no more than 30% in equities, I would just stay. I wouldn't bail. I wouldn't, unless you feel comfortable you want to make a bet. But I don't know. you might want to bet it goes up from here.
Yeah.
So everybody now is talking about buy the dip, and other people are saying don't buy the dip. It's going down further. And this is feeling a lot like 2008 felt, but I guess I'm a believer that the next one maybe hasn't happened yet because there's 9 other things that really could to force it. So I think the coronavirus, that somebody else said this, and I can't remember who said it, but I'm going to quote them so you don't think I'm the smart guy who said it. But I think it's the match that lit the overvaluation tinder.
Mm-hmm.
So the markets are very scared, and everybody knows that the markets are really expensive. So I think the reaction now might be an overreaction, but it might be the beginning of more to come. We'll see.
Oh boy. Well, so to recap on the show, financial advisors, if you do have them, there are some things that you can do on your own to check your risk factors, and if they want to go a little bit further, they can go to Glide Path, or they can help me on this, Ron. What can they do?
They can go to 8-Stage Robo,
Right.
which is a self-help. So they would be on their own with the tools and articles and stuff that I'm giving them. Or if they want an advisor, they can go to Glide Path Wealth Management, and we will give them some guidance on how to at least talk maybe to another advisor, or if they don't currently have an advisor but they want help, we give them some guidance on getting a good advisor.
Okay.
So self-help versus consulting help.
That was easy.
Okay.
Who said that?
Yeah, I said that. So now you want to give the folks a little bit of an insight of what the next shows
Yeah.
are going to be?
Yeah. The next one's going to be, I was going to make a joke and I don't.
Yeah. Okay. My
It's-
brother has a very dry sense of humor,
Yeah,
for
this-
those of you that know him.
This one bordered on a bad taste joke, so I'm not gonna,
I'm used to it, but that's okay.
So the next one's going to be on target date funds. So this is the big breakthrough. 15 years new, still catching on, not really in the mainstream for individual investors, but should be. And then I'm pretty sure the show after that, we're going to bring a guest on.
Good.
And this is the guy I have in mind. I won't mention names in case he changes his mind, but he's an attorney who has made it his life's work now, and he's totally focused not on being an attorney, but on financial literacy. And he basically has a charitable website where he's providing education for people who want to know about how to invest their money.
Oh, well, that's
So,
interesting. Not just baby
I
boomers,
think he'll
anybody.
be interested. Yeah, for baby boomers for sure. Yeah.
Okay.
But for anybody, it's for everybody. Yes.
Okay. All right. Okay, everyone. Thanks so much for watching. Thanks, Joanne, Dale, Lou, everybody for watching. Really appreciate it. And we'll see you next time.
Thank you.
Bye.